Hello, listeners, and welcome back to the Invest with Carl podcast. I'm Jamie Uppenberg, your host today, and a member of the Carl team. We've had some great interviews the past couple weeks, some quantitative fund managers who have spent years of their life working numbers, investments, markets, and technology. And we realized the whole point is that these gentlemen did that so we all don't have to, while at the same time, we thought a bit more context could be helpful. So today we're taking some time to talk about these investments at their core and keeping it fairly simple. Now, before starting with Carl last September, I was a banker for 15 years. Actually, I worked in digital payments like Apple Pay, Google Pay. I worked all the pays. I worked digital payments with all the big players. And in deciding to move over to Carl, I had to do my own due diligence. While I haven't been steeped in investments and markets in this particular way for many, many years, like the fund managers. So point being, I have to keep it simple. So you'll go through some of what I had to learn, and we'll keep it basic. First, I had to get educated on what are quantitative hedge funds, because prior to reviewing the company, I had never heard of them. Now, I had heard of hedge funds, but quite frankly, I had never really considered investing in them or did much research on them. So the side history lesson is in the way, way back machine, hedge funds used to actually hedge with markets or stocks or whatever they were hedging against. And then they just became managed group funds. So you have a group of investors and you have a fund manager, and they use what are considered sophisticated, generally complex methods to invest. And those methods that hedge funds use are proprietary, meaning they belong to the fund managers. They don't tell everyone exactly what they invest in or when exactly they sell, or otherwise it would be more like open source code and anybody could give that investment method a try. This isn't like that. It's private. It's more like a black box for each fund where only certain people in the fund know exactly how they do everything. But because it's not open, financial regulators have limited who these group fund managers could sell to. So they couldn't market openly to everyone. They could only sell their sophisticated investments to sophisticated investors. That used to be institutions or the uber wealthy who had managers. They had money managers of their own, like family offices. So now, personally, I think the sophisticated investment bit, I mean, maybe certainly part of a regulator's consideration. It seems more like they decided that these could be openly sold to groups who like you can sell your hedge funds to people who already know how to diversify and can afford to lose. Because these groups that we're talking about have a lot of money. And it was that way for a long time. Now, this whole exactly, who they could sell to and the diversification and could they afford to lose, that is a personal perspective. It's not exactly the history. Just want to call that out. And those two factors, they continue to be important. It's important to diversify your portfolio always. And we think that that's become much more well known, right? Investing there's so much more information about it. That's more common knowledge than it used to be. And then the other part of being able to, having large sums of money so that a loss is not as impactful, well, that matters when you're investing multi-millions of dollars. But when we're able to bring the minimum investment down, it's not as critical. And we wouldn't anticipate, are you putting all of your money, everything you have into a fund? Well, we would expect that you'd want to do a little more research on that before you put everything in one basket, right? That goes back to the diversification, the importance of diversification. So basically, what the regulators once thought, there are a lot of changes that have happened, and digital has brought about a lot of those changes. Now, whether or not my personal perspective on this is correct, it doesn't even matter because these regulations were made a long time ago and things have changed. Diversification is well known. Minimums and investments have come down. And so the situation with hedge funds and hedge funds themselves are better understood. We have more data. You'll see Carl is bringing more data than ever before. Without still knowing the proprietary specifics of a fund, the environment has changed. So where does that lead us? So these regulations on, sell your sophisticated investments to sophisticated investors, that actually changed a couple of years ago. And the regulation became that it is still limited. So yes, it is still limited while to accredited investors. Now, accredited investors, as an individual, they make more than 200,000. So, they're still pretty wealthy, but it's not so tight. So, um, you this change was made a couple years ago, and then you didn't see hedge funds pulling out advertisements in your favorite publications because, quite frankly, pivoting their hedge fund business to retail investors, which is what you call more regular investors. There's the institutional investors, and then there's retail investors. It doesn't make sense for them to pivot to retail investors. So a good startup hedge fund needs a solid $30 million anchor investment. So if you start dividing 30 million by, 20K, 50K, it's easier for them to just keep going after the uber big fish, right? It's going to make more sense. So we built Carl to basically tag along, and we're bringing in the 20Ks and the 50, 100, 500K investors quickly and easily for funds that pass our due diligence process. And that gets us up to date on hedge funds, right? They're these group managed, they're proprietary, their regulations are different, even though those have eased up a little bit. While I left out a critical word, and that's quantitative. So Carl works in quantitative hedge funds, or really quantitative investment strategies. And this is really at our core. We believe in the power of digital to change the world, and we believe it is changing the investments world. So we chose quantitative funds because they make investment decisions following a scientific approach. Quant fund investment managers rely on the use of mathematics and computer science to build custom computer models that can select investments. And most quant strategies have specific objectives, like to target a certain annualized volatility or to reduce portfolio correlation to a certain market index, or a hedge. They sometimes do actually hedge against a specific factor. A particular aspect of quant strategies is that they generally always include risk management. It is always built into the programs, the methods, the strategies, providing a level of protection that you don't find in other investment options. And we find this also critically important. And definitely risk management is part of our due diligence process, making sure we like the risk management that was built in to the funds that we offer. And we like the intentions of the risk management that's there. So no risk management process is, 100%. It cannot give you guarantees. No investment really can, but it is, we think it's important to make sure in a quant strategy that it has them built in and they have quality intention. So the improvements in technology, and then we have the availability of data has increased the number and opportunities for these new strategies to advance themselves and advance the type of methods they use. And really, you're finding that the amount of data that is available in investments and the markets, it's really more than any human being can process. I mean, that is a fact. It's tough for any human fund manager to compete with a top quant strategy builder. And this is another critical point. That's a top strategy builder. in digital, as in anything, there are plenty of people trying who don't really have the skill yet. And you'll see this in hedge funds overall. That's why we have the due diligence process, and we're not just a listing service. So that takes us through Carl, the history of regulation, how Carl came to be, what hedge funds were and are, and also why we take quantitative strategies and why that's so important to us. So then really, how do you use Carl investments today? I want to make it clear that that's entirely up to you, while I'll point out some of the things Carl is doing to make sure you have a lot of options. So as we bring on funds, you will hear, just as I did today, you will hear us talk about the diversification options. So you're always looking at a quantitative strategy, a quantitative investment strategy that has gone through the due diligence process. While there are different types. So some of our investments are in equities, they're in stocks, and that may match more of what you already have in your portfolio. Some are in commodities. We just brought on Kilimanjaro. That is in commodities. And Carl can be a great way for you to venture out into new types of investments. First, quantitative strategies. You've probably never been in one of those before, potentially. And then you say, oh, I've never invested in commodities. Here's an opportunity to do that with, someone who has been in it for a while, an experienced manager managing the fund. And then you'll also see that there are different types of risk profiles of the investments that we have. You'll see different volatility percents that the funds have. So you can choose, what's the right volatility for you. And you'll also see the funds are different. I call funds that are more like K2 or Kilimanjaro. To me, they're like climbers. Like they're really trying to benefit from all market conditions, right? And they work very hard at that. And then you'll see funds like Olympus. Olympus is the second fund that came out, and it's a tail reaper. It works, and we'll talk to the manager of Olympus next week, I believe. So this will be really fun because it's a different type of fund. It really works to take advantage of volatility in the market. So if you go to the Carl app and you go to Analyze, which is the middle menu button, and you look at Olympus and the graphs, you'll see that as the market goes down, Olympus goes up. As the market sharply goes down, Olympus will sharply go up in those graphs, really at the same rate. It's really very interesting fund. So you have funds that are more for protecting downturns in the market like that. So, Carl is generally considered the alternative investment section of your portfolio, probably about 20% of your portfolio, depending on, if you're using your portfolio for income generation or whether you're, 20 or 30 years from that point. It's usually about 20%. While you can really diversify in this space with Carl quantitative strategies, and you can even diversify within quantitative strategies quite a bit. So there's a lot of opportunity to try some new investments out, see what these can do for you in ways you've never seen before. And we really give you as much information as we can, both in the mobile app and in our podcasts, our audio, different interviews with our fund managers. While they won't tell us exactly what they're doing, there's a lot of information to be had because they are in markets and it's quantitative. You can see some of the trends, where they're going, how it's working, and talk with them. The K2 manager puts out a weekly update to all investors in K2. So there's a lot to know once you're invested as well. All right, investors, thank you for joining us for another episode of Invest with Carl. I hope this has been a little bit helpful for you to know what these investments are and how you can use them in your portfolio. And we will give you more interviews next week. Bye-bye now. Thank you so much.
Thank you for listening to the Invest with Carl podcast. The views shared on this podcast do not necessarily reflect the views of Carl. This podcast is intended for informational purposes only and is not intended to constitute and should not be deemed to be an offer to sell or a solicitation of an offer to buy any security or investment, financial advisory, legal, tax, accounting, or other professional advice. Carl funds are currently available to accredited investors with a minimum investment of $20,000. To learn more about Carl and to download the Carl app, go to investwithcarl.com.